So it's been a year since Trent has been included in the Nifty 50, and since then it's fallen 43%. Year to date also it's down 33%, making the worst performer on the Nifty 50 index. RSI also trading below that 30, marking it in the oversold zone. So we'll take a look at as to what's not working for Trent. Firstly, the growth rate has declined from a 50% to a 20% in the last 4 quarters. We've seen as to how YOY growth was over 50% for Trent in 2024. That has come down to around 20 to 25%. In terms of valuations, that's always been a concern for Trent. Start of 2025, it was trading at 101 times. The trailing 12 months is right now around 106 times. Current PE at 83 times. 5-year average of 131. So it's nowhere near to cheap where valuations are concerned. Plus, FIs have been selling the counter since its inclusion in the Nifty. It stood at around 24.43% in March 23. It went to around 27% around September 2024, but has come down to around 18.4% as of June 2025. So FIs have been selling the counter slowly and steadily. In terms of the ANR consensus that's there on Bloomberg, this is an interesting one. Despite of this kind of selling happening in Trent, a lot of analysts are still bullish on the counter. There are 17 buys right now, 5 holds and 4 sells, and a return potential of 27%. Macquarie having the highest target price of around 7,200 for Trent. Now, what is making analysts exactly bullish? That's the real question. Firstly, analysts are expecting, and this is in line with what the management has already guided for, a 20 to 25% sales CAGR over medium term. That's around FY20 till FY28. This is what they're expecting because of the kind of aggressive store expansion that the management has already guided for. Plus, steady margin expansion is something that they're looking at going forward. They're adopting a lot of AI in their business, which is kind of taking their employee cost down. Plus, they are foraying into newer things. Recently, they launched something called Burnt Toast, which is catering to the Gen Z and newer audience. So they're tapping into newer and younger markets as well. HSBC believes that valuations at this space right now, with the kind of growth that Trent has already guided for and is penciling in, is justified. And in terms of the other factors that have been doing well for Trent includes your revenue per square feet has been steady despite of the aggressive expansion that the management has taken. Plus, operating cash flow has also been healthy. Plus, this is an interesting one because Zudio's share in home market is lower than other retailers in different countries. For example, Uniqlo in Japan has a market share of around 14%. So there's still a lot of runway of growth for something like a Zudio. And lastly, ROC has also been improving because from a 9% in 2022 to a 31% in 2025 is what we've seen in terms of improvement in ROC. So this is the overall view of what's happening with Trent right now.
Fantastic. Thank you for that very, very detailed look at Trent. And in fact, we're going to speak to someone who tracks it so closely, has a great note out on it as well. Jignanshu Gaur, Director and Senior Analyst at Bernstein. Jignanshu, very good morning and great to speak with you. You are optimistic on Trent, but let's start with where you think the problem began, where the last 4 quarters has not been up to the mark.
Thank you so much, Donna. It's always a pleasure to be here. I think there were 3 simple reasons why the problem for Trent from a stock price perspective began. The first was on its revenue growth numbers, which were completely burdened by the expectations. The expectations were to continue a 40-50% growth rate for a while, and that has crashed from 100% to 50% to 40% to now 20%. That's from number 1. Number 2, the lead indicator for their growth was store additions. And over the last 2 quarters, the number of stores that they've added has also been materially lower, which has dampened expectations for the future. Number 3 is the lookalikes similar to Zudio, which have come up in their micro markets where Zudio has strengths. So that gives the impact of competition, and that all three put together create a narrative challenge for Trent as well. So I think those are the 3 narratives which have turned the tide for Trent after its inclusion in Nifty last year.
Okay, then the question of, I suppose, remains, Jignanshu, why are you optimistic? Because the fact is that the margin mix is not looking like it's going to change anytime soon. I think you're penciling an improvement for the fourth quarter of 2026.
Yes. So I think the growth has bottomed out, which is why the expectation is positive for the stock. Why the growth has bottomed out? Because there were certain one-time issues that the trend had, but also it was about resetting of investor expectations. We think that is over, and right now the expectations which are penciled in of around a 25% growth rate for the next 1 year or 2 years is reasonable. On the margin front, we believe a large part of their margin improvement are structural and hence sustainable. Those margins those improvements on the back end have not been done by any other player in the industry in India so far. Right? Which is why at the scale at which Zudio and Westside operate, they are able to throw in 11.5% of operating EBIT margin, which is one of the best in the industry for being a value retailer. So the third part is we still believe store expansion has potential. The slowdown is again temporary because the larger stores which they need in the kind of cities which they need, there is a higher lead time for store opening. And that lead time, I don't think it was anticipated by us or by the company. And hence both the performance of the company and the stock price has suffered. So revenue bottoming, potential for steady or slightly expanding margin and store growth coming back. I think it's an oversold part of the cycle. Maybe we see better times ahead.